Principles of Accounting 1, Chapter 10, Examples. In this first example, we're looking at a decision of a company to decide to expand, and if they expand, whether to take a loan out for that expansion or to sell stock to fund that expansion. So debt in liabilities or equity. So what they want to know is what is the result of these decisions. So in our information, we say that we currently have $200,000 worth of equity. The expansion is planned to cost $80,000. We currently earn $50,000 in net income, and the expansion will yield $25,000 in additional income before interest expense. So under our three options, do not expand, expand and issue debt, or expand and raise equity from stock. So under option 1, that's do nothing. That's our current example. So we're currently earning $50,000 in income, tells us. If we expand under options 2 and 3, we know that we're going to get $25,000 in additional income. So our income will increase to $75,000. If we do nothing, we have zero interest payments. If we expand and take on debt, we have to pay interest payments. So we pay an annual rate of 8%. So $80,000 times 8%. We have an interest payment of $6,400. Under option 3, we've sold stock to raise the money, so we have zero interest expense. Our net income is our income before interest minus our interest expense. So now we have our net income under all three options. Our equity is given to us in the problem. So we have $200,000 of equity currently. If we do nothing, we still have $200,000 worth of equity. If we select option 2, we take debt out, so we still have $200,000 worth of equity. If we choose option 3, we sell stock to raise the $80,000. So now we have equity of $280,000. To calculate return on equity, we take the net income divided by equity. So when we see the return on equity, we see that option 2 gives us the highest return on equity of the three options. We would have to determine some other information before we decided if the expansion was a good deal, but as far as our return on equity, it does look like the expansion using debt is financially beneficial for this company. Now we're going to look at a bond issue example. So we have bonds at par value. So that means they're traded at their face value. These bonds are worth $3.4 million. They mature in 4 years and they pay 9% interest semi-annually on June 30th and December 31st. We want to look at the journal entries for all of the payments. So first, we're going to issue the bonds on January 1st. When we issue bonds at par value, we receive cash and we create a bond payable. And those are for the exact amount of the bonds because they're at par value. So this is our January 1. When we pay our semi-annual interest, so our first interest payment is on June 30th, we're going to have a interest expense and pay cash. So the amount of interest, remember, is the amount times the rate times time. So we have $3.4 million times 9% interest times half a year because we pay semi-annual interest. So 3.4 million times 9% times half a year. Our interest expense is $153,000 every 6 months for 4 years. So on December 31st, we would also have the bond interest expense and cash. And we would record these journal entries on June 30th and December 31st for the total 4 years of the bond. At the end of 4 years, our bonds have hit maturity and we retire them. When we retire them, we remove the bond payable from our books and we pay cash to our bondholders for the value of the bond. In this example, we're going to look at callable bonds. Callable bonds are bonds that we call back early before their maturity date. Companies would call back bonds early in order to avoid paying interest payments on them. So if we have 10-year bonds and we can call them back after 5 years, this saves us 5 years of interest payments. So it's a cash savings thing in paying our debt early. So we're looking at 2 different scenarios. The first one is that the bonds have a carrying value of $9,000. So the par value is $10,000. This means that these bonds are currently at a discount. We would record our bonds payable for $10,000, and then we would have cash. And it says that we pay a call premium to call them back early. So we have to pay $10,500 because we're calling these bonds back early. We also have to deal with the fact that we have a $9,000 carrying value. So this is a discount. We have a discount on bonds. And that is $1,000. There's a difference of $1,000 between our current par value and the carrying value. This means that we have a loss on bond retirement. Balance out our equation, $1,500. If the bonds have a carrying value of $11,000, we then have a premium. So we still have the bonds payable on our records at $10,000, and we still have to pay cash of $10,500. But now we have a gain that we need to record of $1,000. We have a gain of $500. We have a premium of $1,000. So those are the journal entries to retire bonds early or call them back early when we have a premium payment, a call premium, and we have either a discount or a premium on the bond. This example looks at an installment note. What an installment note is a liability where we make the same exact payment every single period. This examples of installment notes are a mortgage for a house, car payment. Those are the types of loans that generally have a set payment that you pay every month that is a portion of principal and interest. For our accounting records and information, we would need to determine what part of these annual payments are interest expense and what part is paying down the principal of the note. In order to figure that out, we would prepare what is called an amortization table for the note. So we have a $100,000 note, 7% interest, and we have 4 equal payments of $29,523. So our beginning balance of that note is $100,000. Our first year interest expense is 7%. So $100,000 times 7%. Then the rest of that cash payment is paying down the principal of our note. So our total cash payment minus our interest expense tells us what part of the payment is going towards the principal, that $100,000 principal on our note. So now the ending balance of our note is $100,000 minus that note payable payment of $22,523. Our ending balance from year 1 becomes our beginning balance for year 2. And we do the process again. So we have our interest expense, 7% on the balance of our note. So our note balance times 7%. The amount of our cash payment minus our interest expense gives us our note, what is paid on the note's principal. We then take our beginning balance minus our note's payable payment, and that gives us the ending balance of that note. We do that for all years. So in year 3, our interest payment is on 7% of the current balance. As you go through an installment note, the amount of interest expense you have to principal switches. So you pay higher interest rates, higher interest payments in the beginning of the loan, and your interest payments get less and less. So the equal payments that you pay every month start paying more and more against the principal. As you can see here, because of rounding, our last payment pays $1 more than what we currently owe on the note. So that payment would be reduced by $1 to pay off our final payment, and we would pay off our note in full.